Good morning. Happy Thursday. Welcome to today's episode of Morning Well. Three things that we will talk about. FOMO, the fear of meaningfully underperforming. Germany extends crisis job support. And what to expect from Jackson Hole. US stocks set records again on Wednesday, buoyed by more data pointing to an economic recovery and a continued rally in technology shares. The S&P 500 was up 1%, notching a fourth straight record close after bouncing back from its March lows. Nasdaq was also extended its record streak, marking the fifth straight gain. It was up 1.7%. Now, Dow Jones was up also, but it was up only 0.3%. The market is benefiting from reduced volatility, improving economic data, and the belief that central banks will keep taking steps that ultimately will make buying stocks more appealing and keep it appealing for the near future. Volatility in the US stocks has been muted through much of August as many investors and traders are taking summer vacations in the US and Europe. Still, markets have continued churning higher amid low volumes that we have seen in the past couple of weeks. Investors have grown confident that the Federal Reserve and other central banks will continue to bolster the economy by holding short-term interest rates low and buying government bonds and other forms of debt. We had durable goods data come out yesterday, and the durable goods data surged 11.2% in July. That's more than double that of what was expected. Orders for defense aircraft and motor vehicles drove the spending higher, but even without those volatile categories, the figures did exceed the forecast. Stats like these will likely feed investors who are confident the recovery is continuing, said Tobias Levkovich, the head of US equity strategies at Citigroup. Earlier in the week, he bumped higher the target for S&P 500 for the year, saying that central bank support and investor appetite make it more likely stocks will remain elevated, even if there are questions about the health of the economy. He cautioned that the data is still coming off lows, but said investors are paying close attention to acceleration. The markets are following momentum right now, is what he said, because it's a sign of progress. But at some point, we have to look at absolute levels. So he's calling this whole phenomena FOMO, which is the fear of meaningfully underperforming, and which is why asset managers are continuing to remain invested. Germany extended a program that has kept millions of people from losing their jobs, allocating about 10 billion euros more to help Europe's biggest economy recover from the coronavirus. Dollar mostly weakened while gold advanced more than 1%. In terms of sector, energy and utility were both declined. So Chevron, ExxonMobil were down. Tech stocks were once again driving the market higher. Shares of Salesforce jumped 26% after record quarterly sales and the fact that they'll be added into Dow, which we spoke about yesterday. Netflix was also up 12% and Facebook was up about 8.2%. Jackson Hole would be coming up later today. So there are a couple. Later today, we'll be getting comments from Jerome Powell from the Jackson Hole Symposium. Here's what we know, and here's what we can probably expect as well from the comments. So the first is Powell will confirm that US needs ongoing policy accommodation. The second, Powell's outlook will be cautious. The momentum in the US economy is slowing. President Trump did pass the executive order to extend the extra unemployment benefits, but so far only Arizona is the only state that is making the payments. Other states said it would take about 3 to 8 weeks before the infrastructure is in place before beginning these disbursements. So he will be mindful about the fact that if support is not going to go to the consumer is not going to feel confident, and hence it might not result in retail sales. Third, and probably the most important at least from a market perspective, is about this inflation targeting that everybody is talking about. Like, consumer prices has undershot the central bank's target for most of the past decade. Powell is expected to outline the central bank to drive inflation higher, which represents a dramatic change from the Volcker period when the focus was on taming price pressures. there is talk that he could use the term average inflation targeting, which could imply that the Fed could allow CPI to exceed 2% in order to keep average inflation at that rate, at 2%. So since we had low inflation for a long period of time, getting inflation to print higher will not harm on an average inflation targeting kind of regime. Language like this could be positive for stocks, but negative for dollar, as it means that the central bank will allow monetary policy to remain accommodative for longer than necessary. So a lot of things that we will be looking forward to, and it's important, as I've mentioned to you, the only game in town is what the Fed is doing. So it becomes even more important to just understand what is coming from there. That's the update. Stay safe and healthy, everyone.